Good day, fellow investors. My name is Sven Karlin, and if you own index funds, this video is for you. What is an index fund? An index fund is an investment vehicle that invests your money and spreads it around into hundreds or thousands of stocks, a little bit in every single stock that is traded on the market. Now, that might seem a good idea because your risks are spread out, but your returns are also spread out. You are missing out on the best investments because you own them just by a small part, and you own also the worst investments. Now, index funds have picked up in popularity since the 1980s. The Vanguard Fund was founded in 1976, BlackRock Fund was founded in 1988. And since then, their funds have done extremely well. They did so well that especially in the last 5 years, index fund popularity exploded. From a total of 1.9 trillion of assets under management just 5 years ago, their assets under management exploded to the current 5.4 trillion. So they almost tripled in just 5 years. What happened? Well, people see what has been going on in the last 35 years, how index funds performed very well, and people put their money into index funds. However, they are not thinking, and they hope that what happened in the past will replicate itself in the future. That's not the way how to invest in stocks. There are 3 reasons why index funds did well in the last 35 years. The first reason is interest rates. Interest rates in the last 45 years went only down. And if interest rates fall, asset prices rise. You have to understand that interest rates work on asset prices as gravity. The higher are interest rates, the stronger is the gravity on asset prices. For example, if you can save in a bank and the bank will give you 5%, or you can buy a government bond and the bond will give you 7%, you are not going to invest in a stock that has an earnings yield of 5% because the risk is much higher. So you would demand an earnings return of at least 10% from a stock if government bonds offer you 7%. However, at the moment interest rates are very low, returns on savings are miserable, returns on bonds are also terrible, so people think, okay, then stocks are the next best thing and I'm willing to pay as much as it's necessary to own stocks. My question is, are you sure that interest rates are going to stay down or even further decline, even if they don't have where to decline in the next 35 years? So that's the first thing to think about. The second reason why people invest in index funds is their wrong perception about their success. If we take a look at the S&P 500 in the last 35 years, it has performed extraordinarily well. It went up 25 times. So you might say, index funds, great investment idea. However, if we look at the Nikkei, the Japanese stock index, those who invested in the 1980s are still at a loss now, 40 years later. Those who invested in the Dutch stock market index 20 years ago are still in negative territory. Also, those who invested in the UK stock index, the FTSE, haven't had significant returns in the last 20 years. So when somebody sells you an index funds, ask a lot of questions. Don't get blinded by the performance of the S&P 500 only. And the third reason why index funds performed so well and why they won't perform so well in the next few decades are valuations. If you bought a basket of stocks in 1982, the earnings yield of those companies was 15%. So stocks were very cheap and their earnings yield was high. Subsequently, in the next 35 years, those who invested in stocks in 1982, the S&P 500 achieved returns of about 10%. Where did the 5% go from 10 to 15? Well, that's the fallacy of index investing, but a subject for another video. However, now the earnings yield of the S&P 500 is 3.3%, so 5 times lower than what it was in 1982. And people still expect to achieve the same investment returns as those who invested in 1982 achieved. Simply the logic doesn't add up here. What you can expect from the S&P 500 is a long-term return of 3 to 4%, not more, because that's the earnings yield of the companies. When you compare it to the risk, if you take a look at the S&P 500, you see that at any point in time the S&P 500 can fall 50% or more. So you are risking 50% of your portfolio for a return of 4%. Does it add up? I don't think so. Now, what to do? Well, the other option is to invest in individual stocks. Warren Buffett says that all you need to do in your lifetime is find 6 good investments, buy them at a low price, and it will make you a very rich person. So 6 is much less than the 500 stocks an index fund owns. For example, if you buy Berkshire Hathaway, a very well diversified American corporation run still by Warren Buffett, its earnings yield now is 5.3%, and its earnings grow at 10% per year. So you can expect there a return of 7%, which is much higher than the S&P 500, and you're equally diversified. So that's one. Then you can also look at the stock I'm buying now. The price-earnings ratio is 5, so the expected return on investment is 20%. Or you can look at my next video where I'll discuss another investment thesis that I'm sure will lead to investment returns of above 10% per year in the next decade. Thank you for watching. Be careful with your money. Analyze always the risks and the rewards. Don't look just at the rewards. See ya.